Welcome to the Financial Advocacy Podcast. I'm your host, David Kinder, the tax-exempt wealth guy, registered financial consultant, and chartered life underwriter, and my co-hosts, Michael Moffitt and Kurt Gibbs. This is a disclosure where we say you can't hold us accountable for any actions you take on your own, just like all financial entertainment shows. We are not providing legal, tax, or securities investment advice of any kind. We do provide general investment information for educational purposes only, and we will discuss alternative financial strategies that do not contain or include securities. You can view all of our disclosures and disclaimers at our website at www.financialadvocacypodcast.com. Look both ways before crossing the street. Let's get started. That's a new intro.
Hopefully everybody likes that intro.
Well, I just, now that we've cracked the code now, our podcast is everywhere now. And I can't believe it took us 6 months to get to this point, but we are now on Spotify, Amazon Podcasts, Audible, iHeart Podcasts, Pocket Cast, Castbox, Good Pods, Acast, SoundCloud, and I think I'm missing one. I don't know. We are wherever you listen to your podcast at. We have cracked the code. We are there. And I'm like, well, if everybody's going to listen instead of just watch the video, I'd better have an Audible audio introduction, not just a video one. I'm like, so I worked on that, and I'm like, that'll work.
It's good enough.
It works. So anyway, happy Thanksgiving. We're doing this Thanksgiving week, which is today is the worst traffic day of the year. And that is where Kurt is. Kurt is stuck in traffic, taking care of some business, some family business. Wish he was here, but that's okay. We got to keep moving on because last week we skipped because last week was when we figured out how to get our podcast everywhere. So I was spending more time on working on the podcast rather than in it. And at the same time, I keep forgetting, like, how do we come up with other topics? And how do we come up with stuff that we haven't covered? And how do we try to avoid it being a political show? Because the political one kind of took off. I did like that.
It did pretty well.
At the same time, what's that?
I said it did pretty well.
It did pretty well. And very happy with that. It took off. We've got a number of clips that are doing well for that discussion. We're like...
To that extent too, anybody that listens or watches us, if you have a specific topic that you'd like us to address, put it in the comments, in the chat, in the whatever, and we'll definitely consider it, at least for future shows. And, we're always open to ideas and things that, whether it's insurance agents or general public want to discuss, we're more than happy to entertain those ideas. So suggestions are welcome and recommended.
Yeah, because sometimes I get stumped. I mean, I didn't have an idea until yesterday. I finally came up. We should talk about this thing. And by the way, this was an idea that came up because I actually had another friend of mine on another discussion forum. He emailed me. He said, "I've got a guy. He just retired, and he's an actuary." And he thought, well, maybe we can do a conversation about dividends. How do dividends really work? What does dividend rates actually mean? And I thought that would be great. That would be a fantastic topic. And when I talked, he reached out to me. We had a pleasant email back and forth. And unfortunately, I told him that, well, I'm a Facebook group admin with over 13,500 people in there, and I got this other group, and I got my YouTube channel over 5,000 subscribers. Thank you all for subscribing, by the way. Hit that like button, share, subscribe, comment, do the things anyway. But I think he got a little shy. He's like, I thought it'd be a conversation with just a few people. I'm like, no, this needs to get out there. He's like, no, I didn't feel quite so comfortable with that. Not that he'd say anything. It's just that, I don't know, maybe just a little shy. Look, actuaries are like CPAs with less personality. That's just how they are. They're not necessarily geared for a stage. I get it. So I left it at that. I said, thank you for the conversation. Appreciate it. If you've changed your mind, let's connect again. Not a problem. But that would have been really good to have someone of that caliber to talk about the topic. But this is something that this has been dividend declaration announcement season. That all of the big whole life insurance companies, they come out and they say, we've got this dividend of this, we've got this dividend of that. There's one company that doesn't play that game, and they're proud of that. We don't mind calling them out. One America is one whole life insurance company. They do not disclose it. And it's not that they have anything to be embarrassed about. That's not the reason. But they say that agents don't understand it, and it's often misrepresented. And it's absolutely true. Absolutely true. And in fact, I was quoted for an article that's on ethics.net. It's actually called Misrepresentation and Ignorance, a Dangerous Blend for Ethics. And so, real quick, I'm going to share my screen and I'm going to share the quote here because whole life dividend rates. And this was, I'm going to scroll back up here. When was this? August 2015. So, I'm on the record for over 9 years on this topic. And whole life dividends, I mentioned that agents describe whole life dividend rates that, companies put an ad in the Wall Street Journal. They say, here's a 7% dividend that they just declared. Look at how great we are. That's the kind of thing that they put out there. And then agents will say that their policies are paying 7%. But that's not how a dividend works. A dividend is not a rate of return on the cash values of the policy. Dividends are a surplus of earnings distributed to their mutual policy shareholders. And agents should not be connecting the insurance company dividend to individual policy performance, but it happens all the time. And so we're going to get into that. What is a dividend? How should it be presented and such? And quite frankly, I usually don't talk about it all that much because it almost doesn't matter. That's the interesting thing. And in fact, what's interesting, the past 3 months, because I've got another Facebook group, and it's called the Advanced Whole Life Insurance Discussions Group. And for the past 3 months or so, the discussions have been really slow because it's just not getting a whole lot of traction right. But no one's even mentioning the company dividend announcements. It's not even coming up. They're not posting and say, hey, Penn Mutual just said this, Mass Mutual said this, New York Life said this, Northwestern Mutual said this. No one's saying it. Now, either they're losing interest in the group, which might be more of the reason, or we're all figuring out that, it doesn't matter. And I hope it's actually the latter. I hope they're realizing that I want to see a trend. I want to see it increasing because dividend rates are typically tied to inflation. As inflation goes up, so does the bond market. So does, the things that base for insurance companies for their rates of returns and such. I want to see it increase over the previous year, but really the rate of return or the dividend rate that it's saying, it doesn't matter, which is the weirdest thing. So here we are. We're going to criticize not necessarily our product, but we're criticizing how sometimes the amateur agent presents it. Again, we are big fans of whole life insurance, but that doesn't mean that everybody that sells it or every policy, every company is, above reproach or above being criticized or anything like that. And obviously, we're not going to be putting a company under under considerate. I don't know how I'm trying to say, but put anybody under the bus.
Under scrutinizing a specific company, I think, is what you're looking for.
Essentially, yeah. And in fact, now, anybody that hasn't figured out, my last name is Kinder. And if you're in the insurance industry, I have inadvertently inherited, not directly, no one's contacted me, but I've inherited a certain mantra or inheritance of the industry because there's these two guys, Jack and Gary Kinder, that have been industry training legends. And so many people have credited their success to the training that Jack and Gary Kinder provided, and like over 50 years worth. And they've trained management teams, they've trained agents and such. Now, I had their new agent success kit back when I first started with an insurance agency about 15 years ago. And there's some outright mistruths in there. And at least I knew it when I heard it. I wasn't even a CLU, but I knew enough. And so what's interesting is one of the statements they talk about, you got to get your power phrases, right? So that you have conviction in the things you're saying. And one of the things they actually said was, our product pays 9%. That was that's a direct power phrase statement from the training. And I'm like, no, that's not how that works. And I'm not about to say that. But yet here's Jackie Gary Kinder, both CLUs, also perpetuating the same mistruth to agents. And I remember sitting in, and this was back when I was in a career agency, and I'd sit in, and this guy was not yet a CLU, but he was going to become one. and he said, he's been in the industry at that time at least 15 years, and he's talking about, we just declared a new dividend of 7%, of XYZ Mutual, whatever. It doesn't matter which one. Doesn't matter which company you put in. And I remember cringing, but of course, I'm not going to interrupt him in the middle of a presentation, right? There's a time and a place to talk about that stuff. You don't do it while you're talking to a client. You can clarify that crap later.
Unless your name is Brian Summerfield, and then you speak up at any time.
Wow, is he commenting now, or is he,
No, I'm just kidding, because he usually does that whenever we're in our group things and somebody says something and he's like, well, what about this? And he tends to do that, but he does it in a way that isn't as
bombastic, sarcastic, obnoxious.
He does it to make the person not feel bad, I guess, is what I'm looking for. But
well, yeah, absolutely. And I try to do the same thing. That's why I hold it back until, what is it? What's the phrase? You praise in public, discipline in private. That's the kind of thing, right?
Yeah.
You're not going to make someone look bad and feel bad in front of a client. Never. I mean, that just doesn't look good in any type of team selling, consulting approach. You just don't do that. But let's talk about what a dividend actually is. A dividend is a divisible surplus that is declared by the board of directors. That's it, bottom line. And here's what's interesting is that it's not necessarily a gauge of profitability. Now, we want it to be, but there was a great company a few years ago. They kept paying dividends. And when you look at their balance sheet, they actually had no business to be paying dividends. That company essentially no longer exists anymore. That company has been restructured and sold and everything. So, but they had some big issues. But why were they still able to pay dividends? Because they declared it from the board of directors. And let's be real. The insurance company knows how agents often sell, and they know that they're doing dividend selling. And technically, dividend selling is more, that term really relates more to securities. When you're talking about stocks and such, you're like, well, this stock just declared this dividend, you should buy it too. Well, once you buy it, you can't get dividends retroactively. You get to, once it's declared, it's declared. And I don't care if that's a stock or whole life mutual insurance, doesn't matter. Once a dividend's declared, you've got it, as long as you're eligible to receive it when you're either a stockholder or a policyholder as of the day that they declare it. But yeah, dividends, it's so misunderstanding. So I remember hearing years ago, and maybe it was on the discussion groups or something, I can't recall, but maybe, and I'm going to pick two big names, and they're both great companies, but let's say a New York Life agent wanted to replace a Mass Mutual contract for a client because Mass Mutual's dividend was, I'm making up numbers here, Mass Mutual's dividend was 7.2, but New York Life was 7.5. Therefore, that makes ours better. No, that's not what happens. And so the hard part is 7.5% or 7.2 or whatever the number is of what? That's the key thing. What is it? A thing of what? And it's just represented as a number. Now, something that I have actually liked over the past few years, because dividend rates have gone down, the rate went down, but the amount that was being credited has gotten bigger. So companies weren't expressing it in a percentage. They were saying it in a dollar amount. We're going to give out the biggest dividend in history. And they say it's 300 million. No, what was it? I think Penn was 200 million. I think One America, smaller company, I think theirs was like 37 million. And then Mass Mutual was like 2 billion, whatever it was. And they're throwing out these numbers, and I actually appreciate the larger dollar amount as opposed to a percentage rate. A percentage rate still doesn't mean anything. So I wanted to go here because I've got all the stuff. Now, remember, what if people started calling me the Google of life insurance? The good news is I know how to look stuff up. At least I don't have to write it.
I guess in just as a quick mention to that too, I mean, Penn and Mass have way more policyholders and are much bigger than another company like One America.
Mhm.
So even if they're saying they're paying X dividend, they're also a much larger company. So it may not even be any different anyway in terms of
Yeah,
how the client receives it.
yeah. In terms of how the client receives it is a huge issue because not every policy gets the same dividend treatment. Now, generally speaking, because that's all we can do. Because when a company declares a dividend and they're going to distribute it, it's usually based on whether it's open book of business or closed book of business. The closed book of business might get different dividend treatment than the open book of business. Penn Mutual, when I look at their thing, they got all kinds of closed book and different policies issued in different years, and they're all going to get different treatment. Okay, it just is what it is. But generally, it's distributed on the bigger the policy, the longer it's been on the books, the larger the cash values that have been put in there, the better the risk, or even the worse the risk, because standard gets the worst dividend treatment. If you're worse than standard, you're putting in more cash values and such, you're going to get better dividend treatment. If you are better than standard, you're going to get better dividend treatment. So standard, it gets the worst, strangely enough, and it's just distributed accordingly. It's not a rate of return necessarily. It's all based on all those factors. It's all proprietary to each company. Each company is going to do their thing. But wanted to share here. I'm going to add this here. This is out of because you guys know I'm a nerd here, and this is out of HS 323 Individual Life Insurance. This is the CLU textbook. So it's based on a divisible surplus. The directors of the company, the board of directors, they decide what portion of the total surplus should be distributed in dividends the following year and what portion should be retained as an increase in contingency reserves, right? It's a company. They should hold on to profits, as long as they know what they're holding it on to, and this is a little bit of hearsay, which might include the next year's dividend. Don't hold me to that. I'm throwing that out there because if the company is possibly in danger of not paying a dividend, they would rather pay something than nothing. The worst thing they need for their agency force is to figure out that, oh, we're not paying a dividend. That's the worst thing because they know that would cause morale issues, questioning of all that stuff. But they're going to pay that sum, and it becomes, once they declare the dividend, they're going to pay that sum. It becomes a formal obligation of the company. Now, the divisible surplus then becomes a liability, meaning it has to be paid out because they're going to be paying out to all the participating policyholders. And it's no longer part of the company's surplus. The balance is they balance the need for general contingency fund against the advantages of pursuing a liberal dividend policy. But a needed surplus is decided upon first, and then the remainder becomes a divisible surplus. This is how it all works, and it's usually proprietary. They even say that in here somewhere, I'm pretty sure. But there's a whole lot of stuff in there about how they go about, distributing a dividend and such. But the minimum objective of most companies is to continue the current dividend scale. They would like to increase it if possible, if it makes business sense. If they have to decrease it based on business and based on interest rates, whatever it needs to be. There's a lot there in CLU. So I know we've got a whole lot of insurance agents that follow us and such. It's in the textbook, guys. There's a reason to pick up one of these books, Mike. Anyway, but that's that one. But what I really like is that there's these other guys, the Insurance Pro blog. These guys are amazing. You talk about nerds. I'm going to get back to that. Who is it? Brandon Roberts, Brantley Whitley. And they actually don't have letters after their name, but man, are these guys nerds. And I appreciate that because that means they could write it and I could cite it as opposed to me trying to figure it out myself. But the neat thing is that they ask the question, if you have a dividend that's being declared 8.5% of what? What does that even mean? And so they talk about all of those things. For example, if the life insurance insurer declares an 8.5% dividend interest rate in 2018, this was like 6 years ago, it means they intend to use 8.5% as the input for part of the calculation that determines a specific policy's dividend. And that is attributed to the investment component of that policy. It does not mean that the policyholder will earn 8.5% on their cash value. So, and whatever that value of that number is never disclosed, considered proprietary information. So whatever it is, and the whole report goes into so many things, but the thing is that 8.5% is great. We're talking about mathematically. 8.5% is greater than 7.8, but 8.5% of 100,000 is certainly not greater than 7.8% of 120,000. You cannot compare between them, but you can sort of compare within. We just need to have all the factors, which is why when I look at other policies and such, I'm not looking to replace. I want to help people actually find reasons to keep the policies they have. I'm not looking to find any particular reason to replace unless the policy is not funded well, which is a bigger issue because this number has nothing to do with how well the policy's been performing, how well it's been funded, how the policy holder's been treating it. That's a whole nother issue. But when we get down to dividend declaration season, all these companies, it seems like they're all creating their own measuring sticks. And they're all trying to say, we're bigger, we're the biggest and the best. We're trying to give our people, their agents, a reason to brag. And quite frankly, it's not that big a deal.
Even in the article there, that you just had up, in the very next line, they admit that it's essentially a waste of time to compare dividend rates from one company to another because it doesn't necessarily mean anything.
Yeah, and so when we look at the history of our podcast here, and let's see, how many toes have we stepped on? Let's see. I think we've stepped on the MLMers, we've stepped on the IULs, and now we're stepping on our own cult, more or less. Let's call it a cult. We're all our own cultists. The question is how well brainwashed are we?
Right. It's our own favorite product.
Exactly. It is our own favorite product. And what I like is that we will dissect it. And I just want the best information for the consumer to make sure that they're understanding what their agent may or may not be saying. Because if an agent is saying, well, our policies now pay 7%, look at this recent dividend thing. No, that is not how a dividend works. And I'm sorry, you might need to fire your agent. No, well, maybe you should. I don't know. I mean, it just means that they've been parroting the same stuff that they've been told because it keeps being repeated from multiple sources, and who's going to correct them, especially if it sounds like they're going to make a sale because of it. Now, is there any harm being done? I don't think there's harm being done. It's just not being represented properly. It's not. Yeah, it's just not the truth.
Well, there's not necessarily harm being done. It's just agents don't necessarily understand what it means and how it works. And in some cases, there could be some harm being done because the client won't get what they're expecting to get based on how the agent is,
now they're presenting it,
to be, so that could be a problem.
Yeah. So when we look at, for example, a whole life insurance policy, in our favor, we like limited pay policies. But one of the things that's interesting is that once we put in, let's say a 10-pay policy, we put all the premiums in for 10 years, we might break even in the 10th year. Usually we're just a little short. Okay. Which means where's the return? If we're barely breaking even, I mean, a true investment return has a gain above what you've put in. If we've got, and we're collecting dividends the entire time, and we want good dividend treatment and everything, but the fact is there's no return until you finally have your cash values exceed your premium payments. Until that happens, there is no return, which brings up the other part, which is the biggest myth. Technically it's true, but I'm still calling it a myth because we're going to follow the logic here. The myth is dividends are just a return of unused, overcharged premium. And I love this one only because, quite frankly, it's one of the greatest secrets about life insurance. And the way I look at it is that the life insurance companies let the IRS classify it this way to preserve the tax benefits. That's, to me, the best way. Now, granted, is the insurance companies going to actually let the government do it? No, it's just the way I'm phrasing it, right? So, and there's an element of truth to it. So let me share my blog article. I wrote this. It's on my website. It's under the myth I can't even say that now. Myth. Okay, so here's the thing: the nature of dividends is that yes, at first it is because you're essentially to be in a participating contract, you're going to be paying a little bit more than if you're in a non-participating contract. We already know that that's part of it. So in a way, you got to pay into the system so that the system will pay you. One of my other favorite jokes is that sometimes people will ask on Facebook or whatever, they'll say, "Describe your profession poorly." And I will say something like, I am a fundraising specialist for the largest legal, ethical, moral Ponzi scheme ever in human history. And the question is, can I get you in? Will you qualify for me to get you in so you can benefit? And once you really think about it, yeah, because this is a voluntary program, it pays out benefits by contract. It's been around for a good, 180 years. Let's just call it that. Almost, yeah, we're coming up on that. And the thing is that when you pay into the system, eventually the system will pay you. Now, when we look at the logic of if I'm overpaying a premium, once I get all my money back in dividends, wouldn't that stop the dividend flow? And it's right here. The dividends don't stop. So I took, this is an older company, which doesn't exist anymore, but it illustrates the point for when it did exist. This is, and I apologize for all the small print, but I took an age 35 standard non-smoking, and we did a pay to age 65 policy. $10,000 a year for 30 years. So how much did we put in? We put in 300,000. And so, and of course, I marked this up because I'm trying to make a point. We put in 300,000 by age 65. We have growing dividends, and by age
Can
76, this is.
Can you maybe blow it up and make it a little bit bigger? Is that possible?
I will try. I tried doing that earlier, and well, wrong window. Let me try this one. Nope, that didn't work. A little bit better. Here we go. That's a good sign. Okay. So here at age 65, we put in the 300,000, and then age 76, this is the year after, 10 years have passed, the next year, we've received over 308,000 back in dividends. Cumulative dividends. Now that's not the per year, that's cumulative for the entire time. You've received your money back and it keeps going. To me, that's the miracle of it, because the dividends don't stop. If the dividends did stop, then it would be only the return of excess premium. You already got your premiums back. There's no more excess to get back, but they keep paying you more according to the current dividend schedule, right? So this is obviously an illustration of showing what's possible. But that's the part of the magic of whole life insurance. Now, let's bring up one of the other bad parts of the history of how whole life insurance was sold in the past, which they called it vanishing premiums. Because what they would do in the past, they would set these up and they say, well, and this was definitely in the 70s and 80s when we were in a higher interest rate environment, they'd say the dividends will eventually pay your premiums for you. And they call it a vanishing premium. The NAIC now says that that is an illegal tactic. In fact, you can't call it that anymore. If one was to do it that way, we actually have to call it premium offset by policy values, because the premium is always there. It's always in the schedule. The premium never goes away. The question is, where is it being paid from? And you can use your policy values to pay your premiums, automatic loans and things like that. There's ways to do that. So, they had to put the kibosh on that sales practice. So, but at the time, the whole idea was, hey, dividends are going to keep going up and up and up, and it's going to offset. And you're not going to have to pay premiums after 15, 20 years, whatever the time frame was. And I think this might have been before TAMRA, TEFRA, and DEFRA, the tax code changes in the 80s. So there's all kinds of things that made life insurance pretty attractive at the time. And the government is now saying, you know what, you're trying to make this an investment, meaning you're trying to make it for yourselves rather than widows and orphans. We're going to tax it like an investment. And that's why they came up with more modified options and things. All right. Alonzo's asking, Question: does the dividend option change things? Now, everything I've been showing is showing that dividends are going to paid up additions. We're reinvesting that. You could take your dividends as cash. You could use dividends to buy additional term insurance. There's other things there. I'm just showing it just accumulating back in the contract. It's buying paid up additions. That's all I'm showing because that
So
maximizes the
for
potential of that contract.
so for people out there that don't understand, explain what paid up additions are, so that way.
Paid up additions is essentially a mini life insurance contract that is paid up. You never have to make a payment again. Now, there isn't a separate contract number or anything like that. Basically, you put a certain amount, and essentially you get about 3 times as much of insurance coverage for what's being put in. I think that's the kind of ratio. Don't
Yeah,
quote
it's
me on
close.
that. That's what we got computers for, right? We let the illustration tell us what it's on schedule to do. But that part of the insurance no longer needs additional payments. It is paid up. It is available as cash to be withdrawn or borrowed against. We usually recommend borrowing against it for the tax-free treatment and to keep the policy as intact as possible. But that's another good reason to always work with an insurance agent who knows those things. And by the way, eventually, I know we just got into Spotify. We're going to have commercials. We're going to have our own commercials. We're going to put our commercials in the middle of these things. I haven't written them yet. I don't have a way to collect information so people can ask. But we're going to do that. It's in the works. You saw how
We're trying to figure that out. We were talking about that earlier this week, but it is in the works.
It's in the works because let's be clear. Yes, there's a lot of agents that listen to us. You're listening to us right now. But at the same time, we're trying to use this to say, guys, we're trying to build a clientele. We want the word to get out and let people realize that we're worth working with. At the same time, if other agents share this with their clients, okay, I'm good with that too. However it ends up being used. But the whole idea is to make sure that we're working with someone who understands the nuances, the nature of these contracts, so that they can be properly represented and that the consumer knows what they're buying and why they're buying it. And so today, this is more of getting into the weeds of here's the nuts and bolts of this stuff. And the fact is that we're not, for our part of the industry that we love, it's not sin-free. We're not guiltless. Granted, yes, there are better guarantees in these contracts. There are some things that I like as compared to perhaps IUL contracts, which have more moving parts
A lot
more moving parts, and which is one of the reasons why I happen to really like whole life insurance, because there's less moving parts, which means I don't have to watch it as much. It just does its thing. As long as we have the proper expectations set, we don't have to worry about it. We're not trying to say it's going to outperform your investments. No, it's not designed to.
No, and in fact, where, like you said, you'll even admit the rate of return is negative.
Yes. Oh, I love sharing that story. I mean, and I think I've shared it here. I don't know. I keep sharing it, so I'm going to share it again. I was at a private. Yeah, I was at a private briefing for private placement life insurance. So there's me and a few other select agents in the room, about a dozen of us. And the presenter has been doing private placement life insurance for quite some time. And he's showing a hypothetical illustration. Now, because these are private placement policies, they don't require the same kind of requirements. And besides, we're all agents in the room, so it's not a presentation.
They don't require necessarily the same sort of underwriting that a typical policy would start to require.
Yeah, they well, I won't get into the weeds on that one, but some do and some don't. Depends on the size, because you make it big enough, the company wants that business. But once you get to 100 million, there's all kinds of fun things, but we're not going there. But afterwards, the presenter, we're introducing ourselves to the presenter and such, and he asked me, so David, what is it that you do? I said, well, I show people how to use whole life insurance so that they can retire off the radar screen of the IRS for income tax purposes. He asked me, what's the rate of return on that? I said, oh, it's negative. And I own it. I'm looking at it. He doesn't know where to go with that, because most people, when you question them on that, and they're truthful about it, right? You got to be, I don't know any other way to be than to just be flat out honest. But the thing is that most people might shy away from it They might say, "Oh, I'm embarrassed because the rate of return or the interest rate stinks." Like, no, I own it. It's negative. And he didn't know what the look on his face was. Just it was class. I'll never forget that. It was great. Um, and of course, all he had to go with was, well, imagine if you could get them 7.5% or so, you know. And okay, I hear what you're going with, you know. But each thing has a different place. Private placement is for those that have a decent higher net worth. Let's just say 10 million plus that is able to be transferred into the policy. The stuff we're talking about, it can also work, for whole life insurance. Depends on, can we get you underwritten? How much can we put in? How do we make sure we can fund it without making it a mech? There's other factors there. But yeah, we can own the fact that it can have a negative return. I'm okay with that. So like I said, with the 10 pay, it might break even in year 10. No problem. It's about what the contract lets you do more than what it earns. And if that's the case, we've changed the entire dynamic of the entire conversation. But at the same time, everyone wants to know, what is the rate of return? So it's like, I understand what we're trying to do. It's not going to be as great, but what's it going to be? It'll be good. That's the best answer I think we've got. It's going to be good. It will be largely predictable because we're working with companies that have paid dividends for at least 100 years, roughly. I mean,
Yeah.
Whatever it is, they've been around for a long time and they have a history of paying dividend. Now, will they pay the same scale of dividend? No. It'll either be higher or lower depending on interest rates, depending on the mortality experience, basically death claims, and based on operating expenses, which is another reason. Well, yeah, go ahead.
That goes back to the thing of, like we were talking about earlier, like the dividend rate doesn't really matter because one year a company might show a tremendous dividend rate, but then the next year they might have a ton of expenses. And so that same dividend rate doesn't apply. So the dividend really is more or less, a moot point, and it's not even really as much of a consideration when you're talking about setting these things up and how they work and stuff like that. So,
right.
It doesn't really factor in.
And it's another reason why I don't want companies getting into the public relations business as much. I want companies to keep doing what they've been doing. Send out your press releases. Here's how great we are. Okay, here's how big our dividend is. Yada, yada, yada. Get your 2-page spread in the Wall Street Journal. Fine. But some people say, I wish the companies would come out and say how good life insurance is. No, they've done that already. They did that back in the 80s, and this is how they got in trouble. Not in trouble, but this is how life insurance came under a targeted attack, more or less, by Congress. That's why we got those laws, TAMRA, TEFRA, and DEFRA, which were all an attempt, and they succeeded in taking out some of the richer benefits of those contracts. This is why older contracts, if you have annuities and life insurance, essentially before 1988, and there's different dates for different things.
And it's interesting how they kind of more or less said, we're going to implement it on this day. And so if you want to take a part in this, you better get it in before this goes into effect. Because they pretty much let the public know, here you go. This is the last day to do this and to get this, tax advantage treatment the way it's currently set up now. But they pretty much just made it so that they could all get their stuff in before the rules changed, and when it was, all their little.
I don't know, it's a 60-day grace period or whatever it was. They had a deadline of it, and that's one of the differences between contracts and accounts, because contracts have effective dates. Accounts are whatever they are, which is why we happen to like the properties of contracts as opposed to retirement accounts, right? The account treatment is based on the tax code, and the tax code is based on whatever the majority in Congress votes on. Whereas contracts usually requires a 2/3 vote. I'm glad we're still neck and neck. It preserves what we've got going on so far. And what's interesting is that in recent years, because of the interest rate environment, remember, we were in a lower interest rate environment until a couple of years ago, and members, the advocates and the lobbying parties of these companies went to Congress. They basically said, and different members of the finance committees and such like that, can we lower the minimum guarantee rate? And this is an important thing. We'll talk about what that really is. The minimum guarantee rate in life insurance, because at the time that the laws were set, again, in the 80s, higher inflation, somewhat similar to what we have now. They set up the minimum contract rate as 4%. And that was starting to hurt these companies. And they went to Richie Neal, who was the head of the finance committee. And Richie Neal was a Mass Mutual agent. He understands life insurance. And basically, he called it out according to all the sources I've heard of the story. It's like, so you want me to take one of the best things of the tax code and make it better? And the answer is yes, because they got to make it easy. So 7702, that's the tax code for life insurance, actually improved because of passing this, because now you can actually put more money into the contract. And when we put less emphasis on the guaranteed minimum rates and the dividend rates, you're going to be able to enjoy that contract far more, as long as you know how you're deploying it in your financial life, as opposed to saying, well, we're going to treat this as an investment. It's not an investment, never was. Notice I kept saying life insurance rate of return sucks. We want it to be good for what it is, but it's not an investment. It has the properties that we like, that we can leverage and utilize, but it's not a security unless it is a variable contract, which is a whole nother kit and caboodle there. I think I covered this pretty good. I just want to make sure we covered this thing, because here was the other part. The last part real quick was that the guaranteed minimum interest rate is a component of the total dividend. So that's something else. So it's not the dividend on top of the guaranteed minimum interest rate of the contract. It incorporates it. So if the minimum dividend, and we're going to use the percentages that we already said didn't matter, but let's suppose that the company said they had a 7% dividend. Well, if 4% was the contract minimum, then you're going to get 3 percentage point, whatever it is, on top of it, right? It's including that. It's not 7% on top of the guaranteed minimum interest rate.
Yeah.
So I wanted to make sure I got that part clear, because they're two different things here. Yeah. And of course,
that, even though, they were running into this issue with these dividends because of bond rates being low, and all the overall interest rates being low in general, a lot of these companies didn't really ever lower their dividend rates by a whole lot. It wasn't like, when they agreed to that, it's not like all these companies dropped their dividends down to whatever the minimum 2, 3, 4%. They were still paying, 6, 7%, whatever it was, so it wasn't like it gave them the ability to do that, but they never did it. And now you're able to put more cash into the contract, so it actually worked out much better for the consumer.
Yeah, much better. And although it just doesn't feel like it, because we're so used to looking at these rates and we say, I want the higher rate. But when you understand what the objective is, the lower rate actually lets you put more money in. It's a weird thing. So I understand that it can be confusing, but once you understand what we're getting the contract for and what the purpose is, we can maximum fund that thing and actually make it work better, more efficiently for us. One more part I wanted to touch on real quick is that
that's kind of, if nobody's, I'm sure a lot of people haven't read it, but if you want, what is it, Leslie Chisholm or something like that? She wrote the Wall Street Journal article how it was a boon for life insurance, how these dividend rate changes made it better.
And there it is. So I'm going to bring it up real quick because I can, and we'll add that in here. Yeah, small tax change is a boon for permanent life insurance. Insurers worried that government rule from 1984 threatened certain products and sought Washington's help. And so there it is, January 10th, 2021. And did I highlight anything? I don't think I did. Good. But anyway, it's like a 3-page article, not too bad. But it goes over what the tax changes were. And what's interesting though as well is I would also beware of, especially whole life insurance, that tends to overpromise far more than other whole life insurance. And the reason I bring that up is this company, First Executive Life. They were AAA rated, which there's technically no AAA rated companies anymore. It's all AA plus or whatever it is now, but there's no more AAA rating. But First Executive Life was a top rated company that they kept investing in junk bonds, and by hubris, They thought that the junk bond interest rate environment would never stop. They kept doing those things because the comp to the agent was the same. The company's overhead expenses were the same, but yet they outperformed and out illustrated everybody. And so when you have that, they kept winning, new business. But the problem is that why is that? The insurance company must always be made whole. If something is really too good out there, why is that? Ask some questions if something's extra good. Now, every company's got a little bit of ebb and flow between different things. That's normal, but it shouldn't be so much more better. That's
It's
good
kind of
English.
like the college pennant that we always talk about, right? Where you have one here and one here, but then they kind of tend to meet at the end.
Yeah, the longer it goes. But what's
Right.
interesting with executive life is that it was at the top and kept going up.
Right. Until it didn't.
Until it didn't, yeah. And in '91, they declared bankruptcy and everything because I met the author. He signed it. Where am I? Yeah. So he told the story because he was in charge of marketing and such there at the time. So um, just being able to ask him what happened there, and then what could we be looking for as agents ourselves, and I didn't quite get the answer I was looking for. So, how can we do a better job of looking out for our clients in picking and choosing the right companies? Didn't quite get that. So there's other things that other people have come up, like this TSR ratio. That's a new metric that has come out recently. Transparency, solvency. I can't remember what it
There
is.
are a
What
lot of
it
other
shows.
things though that I think do matter within the contract, even if the dividend rate isn't necessarily one of them. The way that these
Right.
things are set up and the way that we try to implement and use them, there are certain things within these contracts that the company you choose will actually make a difference on how you're able to use it. So there
Yeah,
is some
that
of
is
that.
true. Yeah, but in terms of like researching the company, like should we be with this company at all? I mean, the other stuff is kind of a little bit moot points. I do happen to like the story of non-direct recognition compared to direct recognition, but really it's six of one and half a dozen of the other. Does it really make that much of a difference in the long term? Probably not. I just happen to like the story better, so I recognize my bias, but I also know I like the story. And there's always a value in a good story and how something presents itself. But really, does it matter that much? Not really. Um, but as far as like, yeah, I don't remember what TSR stands for. So if he's watching, sorry, uh,
Just cause
whatever
you
it is, what it is. But yeah, but there's different things. For example, reserve companies, are they based in the Bahamas and stuff? Where are they getting their reinsurance at? And there's some other things behind the scenes that before Ohio National imploded, because that's what happened with them. They imploded because of the way that they priced their other part of their book of business, which is their annuity part. Now, when we look at companies, we have to look at not just one product. Do I happen to like how that product works? We have to look at the whole picture,
the whole company, yeah.
the whole company, and figure out, is this going to be around? Is this going to be a viable company to be placing our clients with? And the only concern I ever had with One America, and it wasn't based on here nor there, but the thing is that they are big in selling long-term care. And long-term care is a huge issue, and it's only been getting price increases. And they seem to be selling a lot of it. And they said it's their most profitable product, which I'm glad of that. But at the same time, when the claims start coming in, is it going to be well priced? And we've been reassured multiple times, because every time I hear from a wholesale, I'm just asking them, bring it out, because I don't want a product that kind of that has a run on the product to become the downfall of a company. And I'm not saying that that's the case, but I'm like, let's bring it out. Let's make sure that it's been priced appropriately, because I want the company to stay in business.
And
The company has to win. We have to win. The client has to win.
the specific type of long-term care quote coverage that they offer is very unique to them, I would say. So not a lot of companies do it the way that they do, but
Right.
hopefully it's not another one of these things where it works until it doesn't, and then
Right.
what?
Yeah.
So
And so it's not a real concern, because the fact is, the company management, I trust them that they are looking long term. They're not trying to do anything stupid. But Ohio National, they had priced their annuity book of business poorly and put it into their prospectus, because it was all their variable products, that they could not increase their costs. And every other annuity, because I sold them back in the day, they all have the provision where they could increase their costs. And because they couldn't, based on the prospectus, that's why fiduciary agents and advisors, those that want to look out for the best interest of their client, they look at that and say, this company can't increase their costs, everybody else can. We're going to put you here. And I see the rationale, and I wouldn't blame them for that either. But now we could see that could be an albatross around the neck of an insurance company. If you have too much business in one type, and then you can't continue to get the reinsurance for it, it becomes a problem. And so now the lessons of Ohio National is that we have to look at everything. We're not just looking at what product do I like, what's the sales compensation. No, we got to do our due diligence. So it's not just presenting it right. Let's make sure we got good companies, good management that are putting the client forward, and they're not doing anything crazy.
So there is some modicum of truth to which company you use does, in theory, make a difference. But as far as the whole dividend thing goes, not so much.
Yeah, if you're choosing between New York Life and Mass Mutual, who's going to underwrite you better? That's the only thing I think I'd look for first. Get the underwrite, get the offer, then make the decision. It's not based on what the news media and what their dividend declared dividend is, because it's immaterial.
Yeah,
that part does not matter.
It's crazy because and it does matter, because I had a client recently that was going to get priced as standard one place and they got preferred in another place. And so, if you're going to get a better rating, obviously you would by default want to choose that, and going back to the whole dividends don't really matter thing. Well, why wouldn't you rather get the better price, the better pricing? So yeah, it does matter to some degree, but not to the degree that people make it out to be, with comparing my dividend got 8% and theirs got 7.5% and this and that. And that's totally irrelevant.
Yeah, exactly. And so I should put together a checklist, how to spot an amateur life insurance agent. And the first one would be if they quote you anything other than standard. That's the first warning sign. And then the second one is, are they trying to sell you on their dividends? So far I've got two. I should make a checklist of like 10 of them, right? And just throw it out there.
Yeah, I mean, I always in this, I learned this a long time ago. I run every quote at standard, because that's what the person should expect to get. Standard is standard for a reason. Most people probably will get standard because that's the standard rate for somebody of your age, male or female, and whatever else. So that's what most people get. And if you get preferred or preferred plus or Superman or super preferred or whatever the other ridiculous things are that they want to call it, elite preferred, or whatever else,
Ultra.
Yeah, elite, ultra, Superman rate. I mean, cool, great. That just means that you're in way better shape than most other people in your class. So
yep,
that's all it is. And this whole thing, the insurance company is always going to issue the policy for whatever rate class you qualify for. So it doesn't matter if I submit the policy as elite Superman rate or at a table rate, for that matter. The insurance company will always give you the price that you qualify for after you go through your underwriting. So I just submit everything as standard, let the insurance company do their underwriting process, and then if they get better than standard, now guess what? You get to make the phone call of, hey, you're better than standard, and now you have a lower premium, or you can purchase more death benefit, than what we first talked about. And that's a much better call to make than the one that says, hey, I quoted you $10 a month for this $15 million term. Yeah, well now it's now it's $3,000 a month. Do you want that policy still? I mean, which phone call would you rather make?
It's almost the biggest legal bait and switch tactics that we ever see that's allowed, because I mean, our job is to set expectations.
And that's what makes me really that really makes me angry when I see these companies advertising, you can get a term life insurance policy for a $5 million or whatever death benefit for $1 a day or whatever nonsense that is. And then you read the tiny little fine print, and that's for a elite rate 18-year-old female, and on a
Annual
10-year
renewable
term.
term.
Yeah, ART, right? Annual renewable term. I mean, the stuff is just, and then you call the company to get the quote, and you start going through all your health and the height and weight and this and that, and then all of a sudden, oh, it's not $10 a month now, it's $100 a month, and you're like, what? And that's why a lot of these. That's why I think a lot of people are upset with life insurance companies, is because of these not false advertisements, because in theory somebody could get that rate in theory, but nine times or 10 out of 10 or better, most people aren't going to qualify for that.
It's slimy.
Yeah,
Let's
it's
call it
really
what
bad.
it is. It is so slimy, and people are, with the best intentions, I believe. They're trying to do what's right for their families, and they want to get cost-effective coverage from a company that they believe that they can trust. It's obviously regulated at some level, and they're trying to do what's right. And then all of a sudden, all those expectations are completely dashed and shattered. And
Yeah,
I
and it
don't
puts a
like
bad
that.
taste in the consumer's mouth, and then they become distrustful of life insurance companies. And it's not even always the life insurance company's fault. There's a lot of agents out there that'll put these things up, and they'll quote these ridiculous rates, and then they come to somebody like me, and I'm more honest and transparent, and I'll say, okay, well, here's the price based on who you are at a standard rate. And they'll be like, well, agent XYZ over here quoted me half of that price. I'm like, that's fine, you might qualify for that price, I don't know, but you know what, I'd rather quote you the higher price and have it come back at the lower price they initially quoted you, than sell you on this maybe unachievable rate, and then have it come back twice as expensive as you thought it was going to be. And that I would much rather set the expectation as this is what you should expect to pay, and if the insurance company deems that you're in great health, then you could possibly get this rate.
Yeah, a quote is a completely different thing than an offer.
Right.
Quotes are essentially meaningless, other than we're trying to give you a benchmark of what you may expect based on the questions we've asked you and such. We want to try to be in the ballpark, but you'll get whatever the offer is. That's what matters.
I mean, literally, I could almost put anything I want on the application, and it doesn't matter. The insurance company
Yep.
will always issue the policy at whatever price they deem that you qualify for.
Unless, hold on. Yeah, we can almost put what we want on the application, except for the health questions.
Well,
Because if the health questions, if somehow, if the health is misrepresented, and somehow, let's say they die in the first 2 years, right? The incontestability period. Oh,
right.
you put down that they were a non-smoker, but they smoke a pack a day.
I
Sorry.
would right.
Yeah.
I need to. We need to clarify that. Right? I was talking about as far as price goes.
Yeah, exactly. No, I agree with you. We can put whatever we want, and then the company will give the rating or a decline based on what the facts are, or at least
Right.
the information that they get.
But yeah, you
So,
always have to answer the questions. The actual underwriting medical questions truthfully on the life insurance
yes,
application, because if God forbid something happens in that 2-year contestability period, the insurance company has the right to either just return your premiums or not pay you anything at all. So
exactly. All right. So I think we covered this topic pretty good. Kind of a masterclass on whole life insurance dividends.
and
It is
underwriting.
not what people think that they are. It is not a rate of return. It does not matter essentially. It's a barometer, and it's nice to see. And I try to look at it from year to year. And obviously, every dividend declaration has either been the same or has improved this past year. Um, we'll see,
And
but
that,
it's not,
and a lot of that is due to the interest rates being higher than they have been too. So, and if
absolutely.
interest rates go back down over time, then dividends may go back down over time as well. But yeah, I mean, things have been, trending up as far as dividends go, which don't really matter. So,
Yeah, we want good interest rates. It does not have to be the absolute best because we're not selling it on or quoting it or using it in that manner. It's all about how are we going to use this policy? We want the policy to be good, but how are we deploying it in someone's portfolio? How is it going to be utilized? That's what's most important, which is why I just
Right.
love owning the
Okay.
fact that, you know what, the rate of return sucks. It might break even by year 10 on a 10-pay policy. I love owning that because now everything can only get better and improve from there. And all I needed is an offer from the insurance company. It doesn't have to be Superman preferred. We'll take it. And again, if someone's table rated, that just means, you pay more, we pay quicker. It's a terrible line. It really is, because you start thinking about it's like, gee, thanks. But
There's a lot of truth to that statement, though.
a lot of truth. First time I heard about that was on a John Savage recording, and I was like, really? He tried to sell using that, and it never worked for him, which I don't doubt it.
Most people probably don't take too kindly to that, but
yeah, it's more like, hey, it's your health. I mean, we're just trying to get you an offer. We can't get you an offer. Well, no, they got an offer. They just got the offer that sucks. We're just kind of telling them what their health expectancy is going to be. Not so good. Anyway, based on that, we're right at an hour here. Appreciate your time here. Thanks for everybody watching and listening. Make it a great day. Hit like, share, comment, subscribe, and find us where all the podcasts are. Again, we are on, where are we at? We are on Spotify, Apple Podcasts,
I don't know.
Amazon Podcast,
Down there
Audible, iHeart Podcast. That's the iHeart Radio, but podcast division. We're on the other miscellaneous SoundCloud, Podcast, Pocket Cast, Castbox, and Good Pods and Acast. Whatever. We're now everywhere. Can't get rid of us, but please hit like, comment, share, subscribe, and we'll see you all next time. You have been listening to an episode of the Financial Advocacy Podcast. As a reminder, you can't hold us accountable for any actions you take on your own. Just like all financial entertainment shows, we are not providing legal, tax, or securities investment advice of any kind. We do provide general investment information for educational purposes only, and we will discuss alternative financial strategies that do not contain accrued securities. You can view all of our disclosures and disclaimers at our website at www.financialadvocacypodcast.com. Look both ways for across the street. Thank you for listening, and make it a great day.